Okay, so welcome back. So here we are. So this is day 2 of the Impairment Masterclass. So we're going to continue where we left off. So remember last night we left off by setting up the solution. Tonight we're going to go and plug in all the numbers in order to determine whether or not we have an impairment loss. Remember, the thinking is as follows. If there is an indication of impairment, then you have to perform an impairment test. The impairment test will be based on an individual asset. If an individual asset cannot generate cash inflows independently, then you will have to test that particular asset within a cash generating unit. A cash generating unit is the smallest group of assets, including that asset, that can generate cash inflows independently. So just take note of that. So in this scenario, you saw that the machinery and so forth were, there was an indication of impairment because of a new competitor entering the market. However, even if there was no indication of impairment, because we have goodwill, goodwill is required, must be tested for impairment annually. Okay, so you have no choice. Goodwill have to be tested for impairment annually. Because you need to test goodwill for impairment annually, you will obviously have to do an impairment test on goodwill. However, goodwill cannot generate cash inflows independently. So you can't impair goodwill or test goodwill for impairment as an individual asset. You have to test goodwill for impairment as part of the CGU. So as you can see, so whether or not there would have been, whether or not there was an indication of impairment, we still would have to test for impairment solely because the CGU includes goodwill. Very important to take note of that. So when you do an impairment test, all you are doing is you're comparing the carrying amount versus the recoverable amount. If you are doing an impairment test for an individual asset, you're comparing the carrying amount of the individual asset to the carrying amount, to the recoverable amount of the individual asset. If you're testing the CGU, the cash generating unit, for impairment, then you're comparing the carrying amount of the CGU with the recoverable amount of the CGU. So in this case, we're comparing the carrying amount of a CGU with the recoverable amount of the CGU. Remember, the CGU, which is the smallest group of assets that can generate cash inflows independently, is the wholesale division or the retail division. We are dealing with the wholesale division. Remember, the recoverable amount is the higher of the value in use and the fair value less cost of disposal. So I generally do the recoverable amount first, that's the easiest. So we will do that, and then as we go along, we'll calculate determine the carrying amount of the farm, determine the carrying amount of the machinery, determine the carrying amount of goodwill. Goodwill's carrying amount was given, so we can just plug it in, and then also determine the carrying amount of the factory. Just to remind you that the factory is a corporate asset. What made the factory a corporate asset is that it met 2 criteria or 2 characteristics. Number 1, the factory cannot generate cash inflows independently, and number 2, the factory is used by more than 1 CGU. Because of that, the factory is considered to be a corporate asset. When you have a corporate asset, you must ask yourself the question, can the corporate asset be allocated to the CGUs on a reasonable and consistent basis? If it can, then you must include it in the CGU. If it can't, there's a whole different treatment. So over here, it can be allocated to the CGUs on a consistent and reasonable basis. Therefore, we're including the factory as part of the carrying amount of the CGU. Very important to take note of that. So now let's go in to do the calculations. So the first one I'll calculate is the fair value less cost of disposal. And the second one would be is to calculate the value in use. Okay, so let's work on the fair value less cost of disposal. So just make sure you have your scenario open. So fair value less cost of disposal. Let me just see, where is this now? So so under note number 4, they told you, so in note number 4 of the scenario, we in the second paragraph, they say brokers indicated that the wholesale division could be sold at a price of 2,186,357 on 30th June 2017. Any brokerage costs relating to such a disposal will amount to 225,702. Okay, so there they gave us the amounts, so we will work it out. So we will say fair value. It was, what was it now? Fair value was 2,186,357, 2,186,357, and cost of disposal was given to us as 225,702, 225,702. So therefore, fair value less cost of disposal would equal the difference between the two. So it's going to equal 2186 minus 225. So this is C29. So now I'll go to the top, and it's equal to C29. Fair value less cost of disposal. So here we have working 1. Now I will work to working 2. Now working 2, we will do the we will work out the value in use. So working 2, you need to decide how you're going to set it out. Okay, so there's 2 ways you can do it. You can either use the 5 buttons on your financial calculator, or you will have to set up a cash flow table. When I say cash flow table, similar to how you'd set up a capital budgeting section or a capital budgeting table or a free cash flow table. So the same setup, okay? How you set it up depends on what information was given. In this scenario, they gave us 5 years of regular cash flow. Okay, so each year for 5 years, the cash flow was 600 and something. So because the cash flow is a fixed regular cash flow, we can use the financial calculator, those 5 buttons. But if it is not, you will have to use the cash flow function on the financial calculator, or just easily put, you must use the, you have to use a capital budgeting format or a free cash flow format in setting up a value in use calculation. So it all depends on the information given. In this question, the information is simple. So therefore, we can use the financial calculator, the 5 buttons on the financial calculator. So what do we want? We want the present value. That is, the value in use is the present value. In order to calculate the present value, we'll need a future value. We will need PMT, we will need N, and we will need I. So if we go to your scenario, they told us in note number 4, the first paragraph, during June 2017, a new competitor entered the dry food market. This resulted in a decrease in the demand for the wholesale division's products. As a result of the new competitor, the future cash inflows of the wholesale division are expected to be 632 per annum for a period of 5 years. Assume the cash inflows will occur at the end of each year. An appropriate post-tax discount rate on a similar asset is 9.07. Assume neither the residual value nor the estimated useful life of any fruity assets have changed since the new competitor entered the market. Okay, so they're giving us for 5 years, and it's a fixed amount for 5 years, 632 to 60. So therefore, I can plug in all the information. So to work out, I'll need the future value. There is no lump sum payment at the end, so therefore I can put this as 0. So there's no lump sum at the end, so I can make that 0. Remember, your future value is the lump sum payment at the end of the term. So the end of 5 years is no lump sum payment, so I can put it as 0. My payment, your payment is your regular fixed payment. So there's a fixed payment of 632,260 that happens every year. So therefore, it's a regular fixed payment, 632,260. I'll put it by payment. N is 5 years. And then I is your discount rate. Remember, for financial management, the discount rate we use is an after-tax discount rate. For accounting purposes, the discount rate we use is the pre-tax discount rate. They gave us a post-tax discount rate, meaning an after-tax discount rate. For accounting purposes, we can't use an after-tax discount rate. We need to use a pre-tax discount rate. So we need to convert that into a pre-tax discount rate. So we take the 9.07%, which is a post and after-tax discount rate, divided by 0.72 to convert it into a pre-tax discount rate. So there we go. Now we can work out the present value. So I'll just say present value. They would probably want I first, then they want PMT, then they want payment, then they want future value, then they want when does cash flows take place, at the end of the period or the end or the beginning. They told us the end. So on Excel or on Google Sheets, to represent the cash flows happening at the end of the year, you put in 0. For cash flows happening at the beginning of the year, you put in number 1. For your guys' purposes, if you are using your financial calculator, your financial calculator will be set. So either it is set at the beginning or at the end of the year. The default setting on the financial calculator is that cash flows happen at the end of the year. So make sure it's in your default settings. So you mustn't see anything on your display screen. If you see the letters BGN or BEG, it means your calculator is set on the beginning. So you need to change that and remove it so that it can be on its default setting, representing cash flows happening at the end of the year. So that's very important. So there we have our present value, which is our value in use, 2,245,000. So that is C31. So I'll go over here and I bring it in. C31, I'm making it negative because we obviously don't want a negative answer. It must be positive. So we'll tell them that they can go look at the answer at working 2. Now remember, your recoverable amount is the higher of the value in use. The recoverable amount is the higher of value in use and fair value less cost of disposal. Which one is the higher amount? It is the value in use. So therefore, I will just say equal to that. Okay, so my recoverable amount is the higher of, because I put the word higher of. When they see a select 225, they know I'm selecting the higher. So the principle I'll get right. Okay, so there we go. We're showing both numbers and then we're telling them we selected the higher. So we have the recoverable amount. Now we must work out the carrying amounts of the farm, the machinery, goodwill, and the factory. Remember, farms are based on the revaluation model. There's no depreciation on the farm. So the only way the farm can change, the only way the carrying amount of the farm can change is through a revaluation. So let's go have a look what they had to say regarding the farms. So the farm is under note 1.1. So they're telling you on 1 July 2014, 2 farms were purchased at a total cost of 408,752. The farms are subsequently measured in terms of the revaluation model of IAS 16 PPE. Revaluations are performed at the end of the year and the farms are non-depreciable assets. The revaluation surplus is transferred to retained earnings when the farms are de-recognized. The first revaluation was performed on 30th June 2016. The value of the farms was determined by using the cost approach in accordance with IFRS 13. The net replacement cost on 30th June 2016 of both farms is 461,360. Neither the residual value nor the estimated useful life has changed since the initial assessment. So what's important to take note, our financial year end is 30th June 2017. The latest number they gave us was 30th June 2016. So you must assume the amount at 30th June 2016 is still the amount at 30th June 2017. Why? Because remember, the farms are non-depreciable. So there's no depreciation happening in the 2017 financial year. And then also, revaluation is not required to happen every single year. You must just make sure revaluation you perform revaluation frequently enough. So it doesn't have to happen every year. So therefore, all we have to do is assume that the amount at 30th June 2016 is the same amount at 30th June 2017. Okay, so therefore, the carrying amount of the farms are given at 461,360. What I'm going to do, I'm going to have a working just to work out the revaluation that was accounted for, because we're going to need to know the revaluation when we deal with impairment. Okay. So here for the farms, we can just put in 461,360, and we can tell them it is given. Remember, they only gave an amount at 30th June 2016. They are testing a principle whether you know that revaluation is not required to be performed every single year. It might just be performed on a frequent basis, every 2 years, every 3 years, every 5 years, whichever one you choose. Okay, so generally companies will do it every 2, every 3 years. So the fact that they never gave anything at 30th June 2017, it mustn't mean you must now go search the whole paper. If you can't find anything, use 30th June 2016, because you must ask yourself, does it make sense? And the answer is yes, it does make sense, because farms are non-depreciable, so there will be no depreciation during the year. And because they're using the revaluation model, a revaluation does not have to take place every single year. So if you read IAS 16, PP under the revaluation model section, they will tell you revaluations are not required every year. You just need to be done on a frequent basis. Okay. Remember I said we want to work out the revaluation gain or loss, or revaluation gain. We need to have that when we come to impairment later on. So for working 3, since we are busy with land, we want them to do the necessary calculations so we don't go back to the information later on in the question. So the land on 1 July, so 1 July 2014, land was, what was it? Land was 408, 572. Land was 408,572. Just make sure I'm using the right numbers, because I could say 5, but it's actually, see, I used 752, not 572, 752, 752. Just check that. Sometimes I'll use the wrong one. Then the amount at 30th June 2016 was 461,260. Okay, so therefore the revaluation gain must have been the difference. So reval gain, remember this goes through OCI. I'm just putting it here so you know. So the reval gain would be the difference, that minus that. Okay, so therefore the revaluation gain is 52,508. Just important for you to know. This revaluation gain is before tax. Okay, so this is before tax. So an after tax reval gain after tax. So just so you know the difference, reval gain after tax, what would it be? Remember, it's going to equal that. Okay, we actually do it the other way around. So if I put in the tax, remember the rule of deferred tax is that deferred tax follows the underlying transaction. Because the underlying transaction is going through OCI, tax goes through OCI. So the tax on this would be the gain at 80% multiplied by 28%. Okay, so just be aware of that. So if I just say that minus that, we would get an after tax of that amount. Just be aware, you want to always keep your mind straight. What number you're busy with, an after tax number or before tax. When it comes to revaluation, anything regarding to OCI, try to make sure you have both. You know both. Okay, doesn't mean you're going to need both, but you want to know both. Oh, so June 2016 is 461,360. Thank you very much, Ashita. Okay. Okay, so there we go, 461,360, not 260. Okay, did I have the right one on top? 461,360. Okay, cool. So now we're going to go into the machinery. So note number 2. So why did I work out the revaluation? When you have a revaluation and you're working out impairment, remember, if there is an impairment loss, the accounting standard IAS 36 says an impairment loss is recognized immediately through profit or loss. But then the standard goes further in the same sentence, in the same paragraph, it goes further and it says, however, if there's an asset that is revalued, you must first reduce any revaluation gain, and then any remaining impairment loss must go against, must go through profit or loss. So that is why we want to know what is the revaluation on this asset, so that only a portion goes through profit or loss. We first reduce the revaluation gain until it is 0. Anything above that, we will recognize through profit or loss. So I'll explain to you when we get to the allocation, then you will see how all this fits into play. Why did I do the calculation now? Because I read the information regarding farms. I don't want to come back to the information later on. I already know. So when I say I mean you as well. When you're doing the question, you must already know that when you read this, you will most likely need this information when you come to the impairment allocation. So one time, do the calculations when you read that paragraph. You don't want to come to the same paragraph 100 times, because then you're never going to finish the paper. So as you read through, calculate all the necessary information you're going to need. I'm not doing this calculation based on what, when I'm doing this calculation, I already know the end goal. I already know where I'm heading. I already know what all I need to do. So that's how you need to be thinking as well. When you're doing your calculation, you must already know what you're going to be doing. You mustn't do a calculation based on whether the stream is taking you. You must fight the stream. You must already know what you want to do. Okay, so like I'm showing you over here, it is not applicable right now. It's going to be applicable later on in the solution. But because I read note number 1.1, I'm doing all the calculations that is necessary for when I get there, so that I don't come back to note 1.1. Okay, that is how you're going to finish your paper. If you're going to come to note number 1 100 times, every time you come to a certain point, you must go back to the same information, you're going to waste time. Okay, so just be aware of that. So now let's go to note 1.2. The machinery. The machinery, they're saying the quality assurance machinery was bought on 30th November 2014 at a purchase price of 1.14 million. The initial delivery and site preparation of the machinery amounted to 89, and the engineer's professional fees amounted to 11,213. The machinery was ready for use on 1 January 2015. 1 January 2015, that is the date when we start depreciating. Okay, they're telling you, okay, then they're giving you all this information regarding depreciation. Okay, so let's go and work out the carrying amount of machinery. So I'm going to go to working for. The carrying amount of the machine is going to be cost price less accumulated depreciation. Accumulated depreciation at 30th June 2017. Fakir. Okay, Justine, I'm not sure to ask your question.
Maybe just check the present value calculation.
What are you saying?
Because I got the figure of 2.245684 present value.
What?
2245681.
Where did you do the calculation?
On Excel.
Same input.
Same input.
Oh yeah, then it's fine. It's Excel and Google Sheets. It's close, so it's fine. Not gonna worry. Okay. Yeah, not gonna worry. So it's fine. 22458. We're happy. So you're gonna get rounding differences. I don't know if Excel and Google Sheets go to different decimals. Okay. So now we're gonna have accumulated depreciation at 30th June 17. Okay, that is going to give me the carrying amount at 30th June 2017. That's what I want. Okay, so 30th June 2017. Where's this now? Okay, so carrying amount 30th June 2017. So that's what I want. But now I need to work out cost price. So remember, cost is going to be made up of purchase price, made up of delivery, and whatever the other thing was called, delivery, and then professional fees, pro fees. So the cost price, if I remember, the purchase price was 1140,123. The delivery was 89. What is 89? 89,101. 89,101. Can someone just tell me what was the pro fees? 11 something. What was it? Akir, maybe. 11, how much?
200.
What is the pro fees? 11,200 and something.
213.
213. Thank you. So there we go. So the total cost. So the total cost would be the sum of this. Just make sure I got the right numbers down. Okay, so the total cost would be all of that. Now we must work out accumulated depreciation. Okay, so now we're going to work out accumulated depreciation. So now accumulated depreciation, all I will do is as follows. Oh, come on, what's happening now? Okay. So accumulated depreciation, all I can do. So there was a residual value, right? So there was a residual value. So I think there was a residual value. Was there a residual value? No. There was no residual value in that scenario. I cannot remember. Okay. So what we will do is now we're going to work on accumulated depreciation. All you will do, you will take the units of production at 30th June 2017 and divide it by the total expected units of production. Okay. So what we will do is as follows. So accumulated depreciation would be cost. It would be units, whatever it was called. What was it called? Units used at 30th June 2017, and then it was then it's going to be total expected production. Okay, whatever it's called. Okay, so what was the production 30th? So the cost price is going to equal that. What was the units at 30th June 2017? 600 and something. It was 669,500. 669,500. Expected is what? Is 1592,484. 1592,484. So remember, just think about it. Each year, the way you're going to calculate depreciation is going to be as follows. So each year, the way you calculate depreciation is going to be as follows. Costs minus residual value. Okay. And that will equal depreciable amount. Okay. That will equal depreciable amount. You take the depreciable amount, you're going to say units in current year divided by expected units. Okay, so each year you're going to do that. So to make the calculation quickly, so what you could have done is use this formula over here. So there's no residual value. So the cost price will equal, the depreciable amount will equal the cost price of 1.2 million. And then you will multiply it by the units in 20, I can't remember the years that we was thinking there was 3 years. So in each year, the units in the current year divided by the expected units. That will give you the depreciation per year. You add up each year and you'll get accumulated depreciation. Alternatively, a quicker way is to still use cost price minus the residual value, which is 0. So therefore, cost price equals depreciable amount, and multiplied by the units to date, the units used to date. So I'm using the units used to date, 669,500. You'll get it from the cumulative column, and you divide it by the expected total production. Okay, so that is what we're doing over here. So all I'm doing, if I, so remember, depreciable amount equals cost price, which is no residual value. So I'm simply going to say cost price multiplied by that divided by that. Okay, so therefore, my accumulated depreciation is 521. So my accumulated depreciation equals 521. Okay, so now I can say cost price minus accumulated depreciation gives me my carrying amount at 30th June 2017. So this is C45. So I go to the top and I have here equal C45. I think, what was it working for? So then we have working for. Goodwill was given 12,550. Okay, so you can plug that in and I can just say it was given. Now I must work out the factory. Okay, so now I must work out the factory. The factory was a separate note. So working 5, the factory was a separate note. Okay, so if you go back to the scenario, we're going to the scenario. The factory was in note 3, but as you can see, we have the under note number 1, there's note number 1.1 and 1.2. We've covered both. In the paragraph before note 1.1, they told us goodwill is 12,550. Okay, nothing in the retail division. We want to look at the factory building. So once again, we need the carrying value of the factory at 30th June 2017. In order to get the factory, we'll need cost price and accumulated depreciation. Okay, so what we will do, set up the same format, cost, accumulated depreciation, 30th June 2017. Cost price was given at 2570. So 2570, 1, 2, 3. We need to work out accumulated depreciation, and this is going to give us carrying amount at 30th June 2017. Okay, so carrying amount 30th June 2017. So now to get accumulated depreciation, all we're going to do, we'll do the following. We will say cost price minus residual value. Can we just say cost minus residual value will give you depreciable amount. Okay. Then we're going to say divided by useful life. So cost price will equal that. Okay, residual value, what was it given? It was given to us as 650. So remember the definition of residual value is the estimated price that you will get for selling the item at the end of its useful life. So that's the 650. 650. So my depreciable amount, costs minus residual value. So remember, this is easy, right? You did this from accounts 1, from first year. The useful life is 20 years. There was no change, so we're happy with that. Useful life, 20 years. So my annual depreciation, so annual depreciation is going to be equal that divided by 20 years. That's annual depreciation. Now, I'm not interested in annual depreciation. I'm interested in accumulated depreciation, which is running from 1 July 2013 up until 30th June 2017. So the number of years from 1 July 2013 until 30th June.
Yeah, I think it's back now.
Okay, can you guys hear me?
Yes, we
Yes.
can.
Okay. We didn't lose you guys.
Accumulated depreciation on the factory building.
So I'm not right here. Some twice. Something just messed up. I'm gonna leave and I'll come back. Okay, so now it is okay. Sorry about that. My son just have a habit of switching off the switch where the Wi-Fi is plugged in. So just messed up everything now. Okay, so so then we get the annual depreciation. I need to see we busy recording. Okay, so this gives us the annual depreciation. Like we see, we're not interested in the annual depreciation. What we are interested in is accumulated depreciation. So this asset was acquired 1 July 2013. So from 1 July 2013 up until 30th June 2017, it is 4 years, 2014, 2015, 2016, 2017. So therefore, we can just say 4 years. So we put in here 4, and that will give us accumulated depreciation. Okay. So it gives accumulated depreciation, which is going to be 96,000 times 4. So now we can, so now I'll get the accumulated depreciation. So my accumulated depreciation is 384. And so therefore my carrying amount at 30th of June of the factory is whatever, 2186. Now remember, this factory is a corporate asset. What made it a corporate asset was that it met two characteristics. Number one, the factory cannot generate cash inflows independently. Number two, the factory cannot be allocated, it's not used by one CGU, it is used by more than one is used by more than one CGU. So that made it a corporate asset. When you have a corporate asset, you need to ask yourself the question, can you allocate a portion of the corporate asset to the CGU under review on a reasonable and consistent basis? The CGU under review is the wholesale division. Can we allocate a portion of this factory to the wholesale division on a reasonable and consistent basis? If the answer is yes, then you allocate a portion. If the answer is no, then you have to follow a different pathway. So over here, they told us that the factory can be allocated on a reasonable and consistent basis. That is why we included the carrying amount of the factory in this. That's why we included the carrying amount of the factory in the carrying amount of the CGU. Okay, so that means we need to do an allocation. So we can't allocate the full 2186 because 100% of the asset is not utilized by the wholesale division. So we only allocate the portion that the wholesale division uses. So therefore, if we just have this over here, carrying amount 30th June 2017. Okay, so now we can work out the portion allocated. So the portion allocated so basically it's going to be the total is the portion that the wholesale division uses is 570. And the total is 950. So therefore we can work out the allocation. Okay, so wholesale division, the portion of the wholesale division is 570. The entire factory is 950. So therefore, the portion to allocate to the wholesale division is basically a weighting of that, okay, the percentage. So or we will just say the portion, the wholesale division occupies 570 over the total 950. So they are occupied 60%. So therefore, the carrying amount allocated. So the carrying amount allocated would be 60% of 2186. Okay. Carrying amount allocated would be equal to 2186 multiplied by 0.6. So that is the portion that will be allocated to the wholesale division. If the factory could not be allocated on a reasonable and consistent basis, then you do not include the factory in the CGU. Okay, so just take note of that. Over, what number was that now? That is C75. So over here, equal to C75. So that was, I think, working 5 most likely. I think it was working 5. We can just fix it up just now if it's the wrong working. So remember, the factory can be allocated on a reasonable and consistent basis. That is why the factory is included in the carrying amount of the wholesale division's carrying amount. Okay, so the reason why it's included in the CGU's carrying amount is because you can allocate a portion to the CGU. If you could not allocate a portion to the CGU, then the factory will not be included in the carrying amount of the CGU. Please, that's very important. Okay. So here we have the carrying amount of the CGU, and we compare to the recoverable amount of the CGU. What you should know, if the carrying amount exceed the recoverable amount, then you will have an impairment loss. The impairment loss is the difference between the carrying amount and the recoverable amount. So the difference is by reducing the carrying amount to its recoverable amount. Okay, so we have to reduce it. So therefore, the impairment loss is 258,546. Now we'll have to allocate. What we'll have to do, we'll have to allocate. So now we'll have to take that impairment loss and we'll have to allocate it to the various assets within the CGU. The standard tells you that once you determined the impairment loss, you have to allocate the impairment loss against the assets within the CGU. So here's various assets within the CGU. The standard says that you must first allocate against goodwill until goodwill is 0. Anything remaining will be allocated on a pro rata basis against the remaining assets. So as you can see, here we have goodwill. We know goodwill is 255. So we first allocate goodwill in its fullest. Because remember, the goodwill is only 12,000, but the impairment loss is 200,000. Therefore, we must allocate against goodwill the full amount, and then the remaining will be allocated on a pro rata basis. So what's the remaining assets? Total impairment minus what was allocated against goodwill. So you first allocate goodwill until goodwill is 0. Anything remaining, that will be allocated against the other assets on a pro rata basis based on the carrying amounts of those assets. So therefore, we're going to allocate 245. Okay, so very important to take note of that. What you should know of the 245, what will go through P&L and what will go through OCI. So what you just want to make know, what of those will go through P&L and what of the remaining assets will go through P&L and what will go through OCI. So just take note, okay? So of the remaining assets, what will go, you must have a look what goes through OCI. And then the remaining goes through profit or loss. Okay, so remember goodwill's impairment loss, any impairment loss goes against P&L. So any impairment loss goes against P&L. So that 12,550, you go against P&L. The remaining, you'd also want to write off against profit or loss. But remember, like I said, the standard says that where there is an asset that is revalued, before you write off against revaluation, before you write off to P&L, you must first reduce revaluation as far as possible. So we're going to leave this blank for now, because we will need to see how much must be written off against. We need to see how much of the revaluation can be written off. So just be aware of that. So now we're going to allocate the remaining assets. I just want to tell you something first. There's two things you must be aware of. First, an impairment can only be written off against assets. Impairment does not apply to liabilities. So in our carrying amount only have assets, okay? Our carrying amount can have liabilities as well, but in this scenario, our carrying amount only have assets. So an impairment can only be allocated against assets and not liabilities. Very important. Now, the second thing what's also very important, the impairment loss in terms of IAS 36 cannot be written off against any asset. It can only be written off against assets that fall within the scope of IAS 36. Remember, what falls within the scope of IAS 36 are the following: all PPE, all intangible assets, and investment property that is measured using the cost model. Investment property measured in accordance with the fair value model does not fall within the scope of IAS 36. So as you can see over here, farms is PPE, so therefore IAS 36 applies. Machinery is PPE, so IAS 36 applies. Goodwill is intangible asset, IAS 36 applies. Factory is a PPE, so IAS 36 applies. So therefore, we will allocate to all these assets. We already allocated against goodwill. We take everything. We first allocate all the impairment to goodwill as far as possible. When goodwill is 0, then we allocate to the remaining assets. The remaining assets is farm, machinery, and factory. Okay, so now we're going to do the allocation. When you do this allocation, you set up a table. Okay, so you can just set up a table. You can use this format. You can do how you like it, but you can also use this format if you want. So now we're going to allocate the remaining assets. Okay, so now we're going to allocate against the remaining assets. So what are the remaining assets? So we'll just say carrying amount of assets. So the remaining assets was farms, or we want to call it the land. Okay, I was putting brackets, land, machinery, and then what was the other one? Factory. Okay, so this is going to be our total. So all we go do, we go, sorry. So now we'll just get the carrying amount. We'll go fetch it. So that C5, that will equal C6, and this will equal C8. Okay, so there we go. So therefore the total carrying amount of the remaining assets, so the total carrying amount of the remaining assets is as follows. Okay, so now we can allocate impairment. So I'll call this impairment allocation. Remember what we're going to allocate? We're going to allocate the remaining impairment. We already took what must go against goodwill. So we're only going to allocate the remaining. So we're not going to allocate the 258. We're going to allocate the 245 because the impairment loss after goodwill has been allocated, that must be allocated to the remaining assets. Okay, so we're going to allocate to the remaining impairment to the assets that fall within the scope of IAS 36 on a pro rata basis based on their carrying amount. So what we will do, we will say farm as a percentage of total carrying amount, remaining carrying amount. So that is the pro rata multiplied by the remaining impairment. Okay, so I'm just going to drag this down. So what you want to see that the full remaining impairment is allocated. So there we did the allocation. Now we must get the carrying amount after impairment. So now I'm going to say carrying amount after impairment. So all we will do is say carrying amount before impairment minus the impairment allocation, which will give me a carrying amount after impairment. So that is what we're doing over there. As you can see, it is going to equal to what we are looking for. Okay. So what do we need to do now? So what do we have to do now? What we'll have to do is the following. The accounting standard says, once you allocated the impairment to the individual assets on a pro rata basis based on the carrying amounts, you will now have to compare the carrying amount after impairment to their recoverable amount. So now we're going to have a recoverable amount. Now we will have their recoverable amount. So somewhere there, they gave us the recoverable amount of the various assets. So if you go to the scenario, I can't remember, we're under note number 4. Okay, so under note number 4, they gave us the recoverable amount of the various assets. You can see the fair value less cost of disposal was given. They gave us, they gave us the recoverable amount. Okay, so the recoverable amount of the farm is 207,560. The recoverable amount of the farm is 207,560. Okay, then we will have a look at the recoverable amount. What was the next recoverable amount? The recoverable amount of the recoverable amount of the machinery was 706,142. 706,142. Then we will have the recoverable amount of the factory. What was that now? The recoverable amount of the factory was 2,187,400. So you take the higher, they gave you value in use and they gave you fair value less cost of sale. The value in use is higher than the fair value less cost of disposal by 400 Rand. So we take the higher, 2,187,400. So I remember 2,187,400. But we can't take the 100%, we must only take 60%, multiplied by 60%, because you need to compare apples with apples. Okay, so there we go. What's happening over here? So the accounting standard says, what did the accounting standard says now? So what do we do? So let's go through the process again so you can understand what I'm going to do now. The accounting standard says the following. When the carrying amount of a CGU exceeds its recoverable amount, you will have an impairment loss. In this case, we had that our carrying amount of the CGU exceeded the recoverable amount. So we had an impairment loss of 258,546 Rand. Then the accounting standard says, IAS 36 says, the impairment loss must be allocated as follows. First, allocate the impairment loss against goodwill as far as possible. Once goodwill is 0 and there's still an impairment loss available, then allocate the remaining impairment loss to the remaining assets on a pro rata basis based on their carrying amount. So we had an impairment loss, 258. We allocated against goodwill as far as possible. Goodwill only has 12,500, so we allocated the full 12,500. What was remaining of the impairment was 245. That 245 must be allocated against the remaining assets that fall within the scope of IAS 36 on a pro rata basis based on their carrying amounts. So that's what we did. We allocated on a pro rata basis based on their carrying amounts. Okay. And now, so once you allocated that impairment, you must check the carrying amounts of the remaining assets after impairment against the recoverable amount. The accounting standard says, once you've allocated the impairment get the carrying amount after impairment. So here we got the carrying amount after impairment. What you need to do, check the carrying amount after impairment against the recoverable amount. The accounting standard says that you cannot reduce an individual asset's carrying amount below its recoverable amount. So here you can see for, what do we see? Here you can see for the machinery and for the factory, the carrying amount was reduced below its recoverable amount. So therefore we need to do a reallocation. So we're going to have to reallocate. So what we'll have to do, we'll have to reallocate. We're going to have to reallocate 58,200. Same thing over here. The recoverable amount of the factory is more than its carrying amount after impairment. So we're going to have to do a reallocation. So take note. The accounting standard says you are not allowed to reduce. You are not allowed to reduce. You're not allowed to reduce an individual asset below its recoverable amount. But you have to go through the various steps. You have to first allocate the remaining impairment against the remaining assets on a pro rata basis based on the carrying amount, as we did over here. You have to do that. Once you have done that, now you check carrying amount after impairment against the recoverable amount. And then if the carrying amount after impairment is less than the recoverable amount, you have to reduce the recoverable amount. Okay, so you're going to have to reduce. You're going to what you're going to have to do, you're going to have to make sure that the carrying amount is not less than the recoverable amount. Okay, so just take note of that. But there's another part to this. You must make sure that the reallocation does not exceed the initial impairment. You must make sure that the reallocation do not exceed the initial impairment. So let's see what I'm talking about over here. As you can see, with the factory, with the machine, the initial impairment allocation is 70,000 Rand. Okay, and that resulted in the impairment after, that resulted in the carrying amount after impairment being 647, which is below the recoverable amount. Okay, so the reallocation based on when we compare recoverable amount to carrying amount after impairment, the reallocation comes to 58,000. Before you accept that 58,000, compare the 58,000 against the initial impairment. If that 58,000 is less than the initial impairment or equal to it, then you can accept. As you can see, the 58 is less than the 70, so therefore that reallocation can be accepted. But now let's look at the factory. When we allocated, the correct amount initially allocated is 129. So that is correct. Okay, we allocated 129 because the standard says take the remaining assets, take the remaining impairment, and allocate it against the remaining assets that fall within the scope of IAS 36 on a pro rata basis based on the carrying amount. That's what we did. So that's correct. But then the standard says compare the carrying amount after the impairment with its recoverable amount. Make sure that the carrying amount after the impairment is not less than the recoverable amount. If it is less than the recoverable amount, do a reallocation. As you can see, the carrying amount after impairment is less than the recoverable amount. So therefore we did a reallocation. How do we do the reallocation? We're saying recoverable amount minus carrying amount after impairment. So there we did a reallocation. Before you accept the reallocation, or check that the reallocation is not more than the initial impairment. So over here, the reallocation was less than the initial impairment, so we're happy. Over here, the reallocation is more than the initial impairment. Therefore, the reallocation needs to be limited to the initial impairment. So here we're going to limit it to the initial impairment of 129,483. Okay, so take note. The reallocation, when you say recoverable amount minus carrying amount after impairment, gave us 130. 130 exceeds the initial impairment. So therefore, we'll have to limit the reallocation to the initial impairment. So now we can work this out. So that comes to 187. Ideally, this needs to be 0. Ideally, this needs to be 0. The reallocation must come to 0. So all you do is you take it against any other asset. So therefore, we'll take it against, we'll take it against so they will go, we'll take it against the farm. So that is okay. You might just make sure that the farm is not obviously going to be less than its recoverable amount. So we can quickly do that check. Okay, so now the final impairment, is simply going to be initial impairment minus reallocation. So the final impairment is initial impairment minus reallocation. So initial impairment minus reallocation. So as you can see, you want it to be 70 minus 58, which gives us 12,000. And then same thing over here. What do you expect this to be? You expect this to be 0. Okay, because initial impairment minus reallocation is exactly the same. So therefore, you want it to be 0, which makes sense. And as you can see, the impairment allocated equals what we wanted, the 245,996. Okay. Your final carrying amount will simply be carrying amount before impairment minus final impairment, which is 228. Okay, so there we go. So that is basically it. So the impairment would be as follows. So the total impairment would be as follows. If you want to do journal entries, I'll just show you in journal entries what we will do. So just follow this format. You can just put it 0 if you don't have it in an exam. Okay, you just make it 0 if you don't have it in an exam. So remember, an impairment loss must be recognized immediately through profit or loss. However, if there is a revalued asset, you will have a revaluation. Okay, so what we will do, you first take against a revaluation, whatever you want to call it. I'm going to call it a revaluation loss. Where does that go through? OCI. Okay, then the remaining goes against impairment, and impairment would go through profit or loss. then you will recognize the credits against accumulated impairment. Okay, so for a revaluation, you take against the actual asset. The only asset that has revaluation is land. Okay, farms is land. So revaluation is written off directly against the asset. Depreciation and impairment is not written against the asset, but rather written against accumulated depreciation or accumulated impairment. So here we will have accumulated impairment. And the first one was goodwill. Then you will have accumulated impairment. Then there's going to be 4 more assets. Okay. Okay, so the other one is going to be land. Then it's machine. And then it is, what is the other one? Factory. So we know goodwill. Goodwill is easy. So we know goodwill. The goodwill one is easy. The goodwill one is easy. It's going to be 12,550. So goodwill one is easy. Okay. Currently, my journal is not balancing. Okay, so as expected, the journal is not balancing, so we didn't fill in everything yet. Okay, so now we included goodwill. Okay, so goodwill is sorted. We know is a revaluation. So we need to know, and we know the full revaluation is 52,000 based on working 3. So working 3 revaluation over here before tax is 52,608 Rand. Before you write off the full, the revaluation only applies to land. It does not mean that the remaining impairment is 200,000 and revaluation is 52. You must take the full 52. No, you must ask yourself that you must first tell yourself that the revaluation relates to the land, and that is 52,000. So you need to ask yourself, what is the impairment loss against the land? If the impairment loss against the land is more than 52, you first write off against revaluation, and the remaining gets written off against impairment. Okay, so we go to land. The final impairment of land is 233. Okay, so the final impairment of land is 233. Therefore, we can write off first against revaluation, and then anything remaining will be written off against P&L. So you can do a separate thing over here. It's not, you won't find it in your solution, but I just do this to keep myself sane. I know OCI relating to land is 52,608. For the others, there's no revaluation, so it's all 0. The P&L component is simply going to be final impairment minus what must be written off against OCI. You must find ways to make your answer easy. Okay, so I know what's going to be written off against revaluation is 52,608. I can tell them they can go look at working 3. Okay, they can go look at working 3. This is not part of the answer. I'm just showing you how the journal would look, because they can ask you for a journal. Now the remaining will go to the remaining would go to P&L. So now P&L would be that plus goodwill. And now we can just plug in. Remember, what goes against land? The revaluation is written off directly against land. That's going to be impairment for land. That's going to be impairment for machinery. And that's going to be impairment for what we call it. And there we go, my journal entry balances. Okay, so just take note of that. That's how the journal entry would happen. So what's important to take note? There's a few important principles to be aware of. The important principle to be aware of is that this revaluation, it does not mean that the remaining, impairment does not mean that the remaining impairment is 245,000 that you will first write off fully against the OCI. What you must know is that you can only write off against the OCI. So in this case, the OCI related to land. So you need to ask yourself, what was the impairment against land? Okay, so that's very important. So because the impairment against land was 200,000, that means you can take off against OCI. So it's specific relative to each asset. Okay, so just be very, very aware of that. So here was a few important aspects over here. Number one, let me just see what's the time. Okay, we have a few more minutes. So number one, that the corporate asset issue, but we dealt with the corporate asset in full. I want to deal with this allocation over here. The thinking process is as follows. When the carrying amount of a CGU exceeds its recoverable amount, you will have an impairment loss. The impairment loss we got was 258,000 Rand. Once you have that impairment loss, you need to allocate it against the assets within the scope of IAS 36, but there's a hierarchy. First, you allocate against goodwill as far as possible. Goodwill was 12,500. Because the impairment was 250,000, goodwill only accounts for 12,500. That means there will be a remaining impairment amount. The remaining amount came to 245. That 245 must be allocated against the remaining assets within the scope of IAS 36. In our scenario, all the assets were in the scope of IAS 36. So the remaining assets was land, machinery, and the factory building. How do you allocate it against the remaining assets? On a pro rata basis based on their carrying amounts. Here are the carrying amounts. So we allocated on a pro rata basis based on their carrying amounts. So up until that point, we are spot on. But immediately after that paragraph where IAS 36 says, allocate the remaining impairment amongst the remaining assets on a pro rata basis based on the carrying amount, the paragraph after that says, once you have done the allocation, compare, well, I'm paraphrasing obviously, compare the carrying amount after impairment with the individual assets recoverable amount. What you should know that the carrying amount after impairment cannot be less than the individual assets recoverable amount. So here we could see the carrying amount was less than the recoverable amount. The carrying amount was less than the recoverable amount. If that is the case, you need to do a reallocation. So we did the reallocation. But before you finalize the reallocation, you need to ensure that the reallocation is not more than the initial impairment allocation. So this was 58,000. The initial impairment allocation was 70,000. So we were happy. In this case, the reallocation came to 130,000. but 130,000 exceeded the initial impairment allocation of 129. Therefore, we needed to limit it to the initial impairment. Then what we have to do, we want the reallocation to come to 0. So therefore, we have to take the reallocations and just dump it against another asset. So the other asset that was remaining was the land. All we needed to do that the final, once you take these amounts and dump it against the land, you just needed to make sure that this reallocation against the land does not reduce the land's carrying amount below its recoverable amount. Okay, so we did that check, so we are happy. So therefore, the full amount would have gone against the land. So your final impairment is simply initial impairment allocation minus the reallocation. Okay, so that gives you your final impairment. So your final carrying amount becomes carrying amount before impairment minus final impairment. Okay, so that's important. All you need to know that this impairment needs to be split between OCI and P&L. There will only be an OCI if that asset is a revalued asset. The land is a revalued asset, therefore we did that split. So just be aware of that. Okay, so that is the journal entry. Now I have a few more minutes. So I just quickly want to show you how the actual answer would have looked. The required said the following. If you go to the required quickly, the required said the following, part B, present other comprehensive income in the statement of profit or loss and other comprehensive income in terms of IAS 1, paragraph 91B. So IAS 1, paragraph 91B. So what you should know when you read IAS 1 and you read this the section under statement of profit or loss and other comprehensive income, they will tell you that other comprehensive, they'll tell you that the statement of profit or loss and other comprehensive income can be presented in two ways. This you covered for test 1. So they will tell you that the statement of profit or loss and other comprehensive income can be presented in two ways. Presentation number 1 is using one statement. Presentation number 2 is using a two-statement approach. Now, paragraph 91, paragraph B is the two-statement approach. The two-statement approach says the following. You start off with profit or loss, or profit for the year, profit for the year, whatever you want to call it, profit after tax, profit for the year, whatever you want to call it. Okay, so you will start off, but remember, we need to present. So when you present something, you need the following. You need the company name. What was this company's name now? Fruity Ltd. So you need the company name, Fruity Ltd. You need the statement of profit or loss and other comprehensive income. Okay, that's for the year ended. Okay, for the year ended, and then you put your date, which is 30th June 2017. So this is a two-statement approach. So the two-statement approach says you start off with profit for the year. They never gave us profit for the year, so we'll make up numbers. Okay, so XXX. Then we will have other comprehensive income. Then you will have other comprehensive income. And now you must plug in other comprehensive income, other comprehensive. Other comprehensive income. Okay, so what was the other comprehensive income? Revaluation. It was we had a revaluation loss. We will have income tax, and then we will have total comprehensive income. Okay. So revaluation loss, we know it's a loss, so it's negative 52,608. We will have income tax on that. That multiplied by 80%, multiplied by 28%. So our total, our comprehensive income would just be the sum of that. Okay, we can just actually do it here. Okay, so that was the final answer. So this was, part B was 20 marks. Okay. So that was your 20. This answer was your 20 marks. So how did you get, because remember, in order to know how much impairment loss goes against revaluation, you needed to do all of this over here. You needed to do this whole table. Okay, so you needed to get to this point to know how much of the revaluation of land must be first reduced before going to profit or loss. So just take note of that. Okay, so that was the final answer. I don't know how strict UNISA is. If you came to this point and you stopped over here, let's just say you stopped over here. I don't know how strict UNISA is, but some university, if you stopped over here, you can see it's 100% correct, but you'll still get straight 0 because they didn't ask you for the impairment calculation. They asked you for the statement of comprehensive income. Okay, so if you didn't get to this point, even if you stopped over here and you got everything correct, they can, if they want to, give you straight 0 because you didn't answer the question. That is answering the question. The 20 marks was allocated over here. Okay, but in order to know how to get, in order to know how much to take against revaluation loss, you needed to do the entire impairment calculation. Because remember, as I explained over here, we know the remaining impairment is 245. That does not mean the full revaluation must, that does not mean that you must first give the full revaluation to OCI. It depends on what is the impairment loss against the individual asset. In this case, the impairment loss against the individual asset is 233. Because as you can see over here, the initial impairment loss against land is 45,000 Rand. Okay, you may have thought, okay, I must only reduce revaluation by 45. But no, after the reallocation, the impairment loss against land is 233, which means I could allocate the full 52,000 against revaluation. Okay, so just be aware of that. That is all that I want to cover for today. If you have any questions, you can ask me. Otherwise, I'm going to stop the lesson over here. Do you have any questions? Is there anything confusing? Maybe ask that. Is there anything confusing? If there is no questions, then we are good. Yeah.
Can you hear me?
I can hear you.
Okay. I kind of lost on K, how we got the 52608 on K25.
Working 3.
Yes.
The asset was bought, the land was bought for 408. The revalued amount at 30th June 2016 was 461. There was no further revaluation. So therefore, the revaluation from the beginning of time up until 30th June 2017 is 52,608 before tax. After tax is that. So that's what we get. So that's how we got the 52,608. Okay.
Ah, okay. Okay, thank you.
Any other questions? If there's no questions, you guys are good to go. This is the level you must expect, just by the way. Okay, so if there's no questions, you guys are good to go. So I don't see any questions. I'll give 5 more seconds. If there's no more questions, I'm going to close. Okay, no questions. Okay, bye-bye.